If you're on Social Security, planning to claim soon, or already on Medicare, listen carefully because some quiet rule changes for 2026 are already affecting how much money people keep in their pocket every single month. And the truth is, most retirees won't realize the impact until it's too late to adjust their strategy. Some people will see a little extra income. Others could accidentally trigger higher Medicare premiums, lose checks temporarily, or pay more taxes without realizing why. So today I'm walking you through the 7 critical Social Security and Medicare changes for 2026 in plain English so you can make smart decisions with confidence instead of confusion. And real quick before we start, comment your name and what state you're watching from so I know who I'm helping and can tailor future videos for you. Let's start with the change everyone noticed first, the 2026 cost of living adjustment. Social Security benefits increased by about 2.8%. Now on paper that sounds helpful, but the real question retirees ask is, did it actually make a difference? The average retired worker saw their benefit move from around $2,015 per month to roughly $2,071, which is about a $46 monthly increase. For many Medicare beneficiaries, that increase helped offset higher living costs and in some cases covered adjustments in Part B premiums. Couples receiving benefits together saw their average household payment climb by around $88 per month. And individuals on disability benefits saw roughly a $44 increase. Now, some people will say that's not life-changing money, and that's true, but even small adjustments matter when you're living on a fixed income. The key lesson here is not just the increase itself, but how inflation, Medicare costs, and everyday expenses interact with your Social Security check over time. Now let's talk about another change that applies to higher earners and people who maximize their work history. Social Security calculates your benefit based on your highest earning years, and for people who consistently earned near the taxable maximum, their monthly benefit numbers changed slightly in 2026. Someone who reached full retirement age and had maximum taxable earnings for decades might see their benefit increase to over $4,100 per month thanks to annual adjustments. But here's what most people don't fully understand: delaying benefits past full retirement age can significantly increase monthly income. Every year you delay up to age 70, your benefit can grow about 8%. That means waiting 3 extra years could increase a payment by roughly 24%. For someone already receiving a high benefit, that could translate into nearly $1,000 more per month for life. Of course, delaying isn't right for everyone, but understanding how timing affects lifetime income is one of the biggest financial decisions retirees make. Next comes a change that impacts people who are still working, especially higher earners. The Social Security taxable wage base increased for 2026, meaning more income is subject to Social Security payroll taxes. Employees continue to pay 6.2%, employers match that, and self-employed individuals pay the combined rate. The maximum amount of income subject to Social Security tax rose from around $176,000 to approximately $184,500. That means someone earning above that level will pay taxes on an additional portion of income compared to last year. For employees, this might mean a few $100s more in payroll taxes over the year. For self-employed individuals, the increase could be over $1,000. And remember, while Social Security taxes eventually stop once you hit the wage base, Medicare taxes do not stop. They continue indefinitely and can even increase at higher income levels. Now let's look at eligibility credits, often called quarters of coverage. To qualify for Social Security retirement benefits or premium-free Medicare Part A, you generally need 40 quarters, which equals about 10 years of work. Each year, you can earn up to 4 credits based on how much income you earn, not how long you work. In 2025, earning about $1,810 counted as 1 credit. In 2026, that amount increased slightly, meaning you'll need to earn a bit more to receive the same credits. Over the course of a year, roughly $7,560 in earnings can earn all 4 credits. It's a small adjustment, but for younger workers or part-time earners building eligibility, it's an important change to understand. The fifth change connects directly to Medicare, and this one surprises many retirees: the IRMAA income thresholds. IRMAA stands for Income-Related Monthly Adjustment Amount, which is essentially an extra charge added to Medicare Part B and Part D premiums if your income is above certain levels. For 2026, the thresholds increased slightly, allowing some retirees to earn a bit more income before triggering higher premiums. Medicare looks back at your tax return from 2 years prior, meaning your 2024 income determines your 2026 Medicare premiums. If your modified adjusted gross income stays below the threshold, you pay the standard premium. But once you cross into higher brackets, your premiums increase, sometimes significantly. The good news is, if you experienced a life-changing event like retirement, divorce, marriage, or loss of income, you can file an appeal using Form SSA 44. Many retirees successfully reduce or eliminate surcharges after retirement simply by notifying Social Security of their new income situation. The sixth change involves the earnings test, which affects people who claim Social Security before reaching full retirement age while continuing to work. If you claim early, there are limits on how much earned income you can have before Social Security temporarily withholds part of your benefits. In 2026, the lower earnings limit increased slightly, meaning early claimers can earn a little more before facing reductions. If your income exceeds that limit, Social Security withholds $1 of benefits for every $2 earned above the threshold. But here's something many people misunderstand: once you reach full retirement age, the earnings test disappears entirely, and you can earn unlimited income without penalty. There's also a higher limit that applies during the year you reach full retirement age, and the withholding formula becomes less strict, only $1 withheld for every $3 above that higher limit. Finally, the seventh change impacts people receiving Social Security disability benefits. Beneficiaries can still work to some extent, but there are income limits called substantial gainful activity thresholds. In 2026, those limits increased slightly, allowing recipients to earn a bit more income each month without losing benefits. The limit is higher for individuals who are blind, recognizing the additional challenges in maintaining employment. While these increases are relatively small, they provide some additional flexibility for people attempting to transition back into the workforce or maintain part-time employment. Now when you step back and look at all 7 changes together, none of them seem dramatic on their own. But combined, they shape how much income retirees receive, how much they pay in Medicare premiums, and how they plan their retirement timing. A small cost of living increase, a slightly higher earnings limit, new tax thresholds, and adjusted Medicare surcharges all interact with each other. That's why planning matters more than ever. A decision like delaying benefits, retiring 1 year earlier, or adjusting taxable income could change thousands of dollars over the course of retirement. And here's the most important takeaway. Social Security and Medicare are deeply connected. Your Social Security check affects your Medicare premiums, your work history affects your eligibility, and your retirement timing affects your lifetime income. Understanding these changes early gives you options. Waiting until after you've claimed, or after you've triggered a higher premium, limits your flexibility. If this breakdown helped clarify the 2026 updates, give this video a thumbs up and subscribe, because every week I share clear, practical Medicare and Social Security guidance designed specifically for seniors and future retirees who want to avoid costly mistakes. And remember, rules change every year, but informed decisions can protect your income for decades. Stay informed, plan ahead, and make sure your retirement strategy works for you, not against you.